most business owners choosing the entity structure without understanding the tax impact. Today, we're going to fix that. So we're going to go over how to understand how much taxes the client would pay if they chose specific entity structure, about asset protections, about different complications related to payroll, bookkeeping, and that all depends what entity the client choosing. So we're going to go over the differences between sole proprietorships, S-Corps, partnerships, C-Corporation, and LLC. And by the end of this lesson, you will understand the difference based on how much taxes they will pay, asset protection, so it depends on potential lawsuits and complications related to that, if they would be able to fundraise, which is very important to some companies, and also how it will impact their compliance, like bookkeeping, payroll, and other things. So let's learn this, and let's together figure it out what it would be the best entity structure for specific business. Choosing the right entity is not permanent, but it can cost you money. Choosing the right structure is a tax strategy. So usually the businesses move up, they start as sole proprietorship, then they decide to become LLC, for example, so they can protect their assets. And eventually they might become S-Corporation for tax saving purposes. And eventually you can switch to become C-Corporation. And that's when people decide to become if they need to raise funds, for example. So that's just one of the examples how it can change. But it's important to choose the right structure at the beginning so you can save a lot on taxes as well. And on time by switching the entities around. So one more time, choosing the right structure is not just popularity, it's a tax strategy. And we're here to help out our clients to choose the right tax strategy. Sole proprietorship is the easiest way to do business. Yes, that's the easiest way, and you are the business. What it means that the owner, sole proprietor, the person is the business. There is no separation between business and individual. What it means is that you personally liable for all the debts of the business, and the business doesn't exist if there is no person. Like if something happened to the person, business is done, right? So yeah, it's the easiest to organize. So all you have to do is basically start using your social security, for example, as a freelancer, and now you're doing business. Eventually you report that income on your Schedule C as business income. That's it. If you want to do business under different than your personal name, all you need to do is go to Secretary of State, whichever state you live in, and just register that with your state, right? So the client will just, let's say I am Not So Boring CPA LLC, or just Not So Boring CPA. Let's not get to LLC. All I have to do, I just go register do this SOS filing statement of operation with my state. And now I can include Not So Boring CPA on my invoices. And then when I report the taxes, I include it on Schedule C. So it will be scheduled under my 1040 individual taxes. It will be Schedule C business income, and I include it as a Not So Boring CPA as my business. And then I include income and expenses, right? So super simple. Another way, if I decide not to use Not So Boring CPA, I can always use my name, Katerina, and I will just send out invoices and use my social security when they ask me for tax ID. So sounds wonderful, the easiest way to do it, but there is a lot of pros and cons related to that, right? So let's just take a look what I just want to make sure I didn't forget anything. Yes, so let's go to pros and cons, the next schedule. So from the pros, why it's beneficial, because like I mentioned, it's very simple to organize. I don't even need to register it. I can if I want to use different than my name as my entity name, but I can also use my name as a business, right? So super simple. And also if I do decide to call my business something else, it takes 5 minutes to register with the state and I'm ready to go. So that's a good thing. So it's simple and inexpensive to start. Like I mentioned, no corporate formalities. So also just register with the state if you want different name or use your name. Pass-through taxation. What it means is that the business itself doesn't pay taxes, I do. So I would need, or your clients would need, just to add it to their personal tax return, Schedule C, and I'll pay taxes on my individual tax return. I have full control of decision power. I don't need to talk to partners. I don't need to talk to other founders, nobody. I am in control, right? So that's pretty awesome. So that's a way to start. Usually majority of the business starts with sole proprietorship. So we can just start with this and then eventually move on or stay there. But also it has a lot of things that are not that perfect with sole proprietorships, and that's the reason why people change this up, or sometimes they only do it at the beginning. So one of them is harder to raise capital. It's almost impossible to raise capital. Majority of sole proprietors, they only have as their capital as individual capital, the owner of the business. That's the only capital they can use. And if they decide to raise capital, usually majority of, like for example, venture capitalists prefer C corporation. Or if you want to be in business with other businesses, then with other partners, that's called partnership. So, but you're one person, one business, your own capital, you're sole proprietor. Another one, it's a disadvantage, is all income subject to self-employment tax. So that one is, there is this whole thing, self-employment tax, it's 15.3% that consists of Medicare and Social Security. So when you're sole proprietor, your whole business is subject to this additional self-employment income. And that's not ideal, right? Because it's a big amount, it's 15.3%. And there are different structures that kind of like, you don't need to pay that self-employment tax if you elect to be something else. And we'll get there eventually. Another one, there is no liability protection for owners, so that's a huge disadvantage. So for example, if you have a loan of $100,000 to buy a real estate, then you would own that person that debt of $100,000. So they can go after you, after your personal assets. So that's why some people decide to, for example, elect LLC, that I'll be talking about in the next section. And so what is this ideal for? It's good for freelancers, sole contractors, gig workers, or low business risk, somebody who need like a quick, fast setup and they can just ready to go. So when I started, honestly, I was sole proprietor, so it's super helpful. So you have your clients and you ask them, and they ask you like, oh, what should I do? How do I start business? The sole proprietorship is the easiest way to start, it keep you moving, and then eventually you can choose what to be and what additional elections you can make. So yeah, so if anybody asks you like, oh, I want to start this business, I want to start receiving money, the clients, they can do it as of today as sole proprietor, and then eventually when they start making money, when they're thinking about asset protection, then there's other things can be done. So the same name, they can incorporate, they can create LLC, but I'll talk about it a little bit later. Partnership is some kind of organization where each partner puts some kind of contributions. It can be an asset, or it can be their skill or time they put into partnership in order to receive allocations of profits or losses, but everybody wants profits, right? So partnerships is the same sole proprietorship, but with a couple owners, right? With a couple partners. So like I just mentioned, it's business owned by two or more individuals who share profit, losses, and responsibility. It is formed automatically when there is two or more partners. So for example, if you decide to purchase this real estate and you have two partners, you are the partnership already, right? So it can be legally formed, it can be not formed. So partnership, usually when you know there's two people, you're not, the clients or partners not going to put their social security. So they have to put in, when they file forms, they have to include EIN, right? So to get EIN, they need to go to the IRS, get that EIN, register their partnership. So now they're official partnerships. But if you're talking about anything related to liability protection, anything else, it doesn't matter at this moment. So like say I have a partner, for example, somebody who is edited videos. I do all the work myself, but for example, what if I did have a partner? So let's say I want to form a partnership, so not so boring CPA, limited general partnership. Let's say it's a general partnerships, and we're going to get into details more on partnership course. So now I am not so boring CPA, general partnership, and I have two partners, me and my friend, let's say John. We have two partners. So now when we formed, we need to create, the very important documents we need to create is a partnership agreement. That partnership agreement will say the partnership name, when it was created. We also would register with the state as a partnership, and now we are determining the rules of the game. So partnership agreement is extremely important, like I mentioned, because it states contributions, it states how you will allocate the income and expenses. It also answers a question similar to like who is going to be in charge of filing tax returns, things like that, right? So it's extremely important as a first step and one of the formal steps to form a partnership. Another topic I want to make sure I point out while we discuss in partnership is existence of outside and inside basis. What basis mean is your investment to the partnership, and that determine how much losses you can deduct. So as example, I am not so boring CPA. I contributed 10,000 to the partnership. Here's my basis, partnership basis of 10,000. That year we made another 10,000, 90% of it is mine, let's assume. So 10,000 plus 9,000, 19,000, those my basis. Those are called inside basis. So based on that, I can decide if I can deduct the losses. So the next year, the partnership made 100,000 of losses. 90% of it is mine, so 90,000. Now, I have 1,900 as my basis, and I have losses of 90K. So I can only deduct 19,000 as my losses that year, because anything above what exceeds basis will be carried over to next year as an unallowed basis. So I just want to make sure you're aware of that. There is this basic situation. So I'll be talking more in details later. So now let's look over advantages and disadvantages of partnership tax return. So it's fairly easy to form, right? So it's similar to sole proprietorship. You just form an entity, you register it with IRS, but nothing complicated. So it's low admin form. Shared skills and collaborative work. That means you can bring partners who are better than you in specific things. So for example, you can bring me as a partner, and you will have somebody with a tax and accounting knowledge, and in exchange I can receive percentage of income on expenses, things like that. Also low flow through, great for losses flow. It's a flow-through entity, so all the losses go to their partners, right? So which is a good thing. In general, it's very simple to understand. And disadvantages could be all partners are personally liable, so it's not fixing our liability protection thing. Tax on income not received. What it means is that if the entity makes money and they for some reason decided not to distribute to you, you still pay taxes. So that can be a problem when you don't have enough cash, but you need to pay. Another one, disputes easily breaks the business if agreement lacking. So so you deal with different people, and sometimes it's kind of hard to reach to agreement, right? So that can be not ideal, or where you want to take your business from here, and that's create a lot of disagreements in partnerships. And self-employment tax, same in self-employed, self-proprietors, self-employed tax, Medicare and Social Security, 15.3%, still need to pay partnership. That's a huge disadvantage. And so what is partnerships what type of people are partnerships ideal for? So those could be like husband and wife trying to start a business, and can be somebody like who are just family business. It obviously would be nice, and just something like very very early stage, like 2 people, like startup or something like that, because it's just so easier to move faster with partnership at the beginning, and then you can elect to be something else. So that's partnerships. C corporation is using corporate structures that it's taxed directly. So the taxes don't go on individuals. They're not responsible. They have nothing to do with it. So the way to think about it is like 2 separate things. Here's business, corporation, and here our as shareholders, corporate partners, right? So yes, separated, no liability, no taxes, almost no connection, right? Except they invest and they receive some dividends back and they can sell part of their ownership. But they're not liable for assets and they're not liable for taxes. Super important. So taxes are, C corporation is taxed at much lower rate, at 21%. So compared to high net worth individual, whose taxes can be 25, 35, 36.5, this is much lower. So C corporation has these benefits of having more money left. So supposedly they redistribute it in C corporation activity and can do better, right? Another advantage for C corporations, they can issue different kind of stocks, which means they will attract different kind of investors. In general, C corporations are beneficial, and the choice of VC capital, so venture capital kind of person. So if you're looking for capital, most likely investors will invest in C corporations. Why? Because C corporations, it's a separate entity that has no liability, and also it doesn't pay taxes. What it means, if you're a specific type of entity, let's say NGO or a foreign investor, you don't want to deal with like this unrelated business income, which it would generate if you're NGO and you care about that. Or if you're foreign investors, you don't want to file US tax return. And technically, C corporation pay taxes, you only pay taxes on dividends. So you don't necessarily need to file US tax returns. So that is why every single huge corporation out there, Amazon, you take all these huge corporations, are C corporations. Majority of Fortune 500 companies are C corporations. So C-Corp is filing Form 1120. They can be flexible with the fiscal year. So year end doesn't have to be December 31st, which, for example, partnership most likely would need to have a calendar year, right? So that's important. C corporation is registered with the state and it's issuing the stock certificate to its owners. So eventually they can sell it out, they can exchange it, like things like that. So yeah, it's separate entity, owners protected, can issue unlimited shares. I also forgot to mention anybody can be shareholders of a C corporation, foreigners, and NGOs, like all kind of partnerships, anybody. So that's very helpful, actually, very helpful. Capital gains and losses cannot be deducted. They only deducted up to gains, and then it's carried over to the next year. There is also a certain limitation, also PROS, dividend received deduction. So 50% of dividends issued by domestic corporation can be deducted. So that's like amazing actually news and extremely helpful. But there is also problems with accumulated earning tax that I'll be talking about more. So let's take a look at pros and cons of C-Corp taxation now. So the most important, low corporate tax at 20%. So corporation has more money to reinvest. Strong liability protection. So its shareholders are protected, right? Unlimited investors, unlimited classes of shares. So that's perfect for fundraising. Easy to transfer ownership and shares. And disadvantages. Double taxation. C corporation pays 21%, and then if it issues dividends, the shareholders are paying dividends as well. And let's take a look. More paperwork, annual compliance. You have to register, incorporate with the state, issue stocks, and related to stock, there is like actually much more paperwork. So it is more complex in that case. And it's not ideal for a small one-owner business just because it's extra paperwork and they don't need different classes of stock. That seems a little bit too much. And the double taxation is not ideal as well, right? Because the individual owner probably wants to receive all the money that corporation makes. And it's the best for startups seeking capital investments, venture capital, angel investors, all that kind of world, and companies who are planning to do IPOs. So, and also I noticed like foreign investors also register as a C corporations. Reason why? Because they don't want to deal with US taxation and they don't have to file individual tax return in that case. C corporation paying taxes. So venture capital and some foreigners. That's majority of it, but not all of it. Let's move on. The central problem with C corporations is double taxation. When there is two taxation paid when C corporation receives income, so C corporation pays tax, and also on dividends when shareholders receive dividends. So the problem is solved by S corporation. So S corporation is the best of two worlds for many reasons. It solves the problem with double taxation the C corporation has. It's a flow-through entity. So S corporation itself doesn't pay taxes, shareholders do, right? And also it provides the limited liabilities that C corporation has. So it's wonderful. And let me explain you more in details about that. No corporate tax, like I mentioned, so all the income flows to the owners. Owner pay tax once and corporation doesn't. Another problem with that, so it sounds too good to be true, right? You're like, oh my gosh, why would not everybody would go to be S corporations? But in reality, it has some issues. So one of them is the concept of reasonable compensation. So every S corporation has to issue salary. If it generates income, it has to issue salary, right? So what is reasonable compensation? Let's say I am a CPA business, which I am, and my business makes like, let's say 150K is a net income. And I decided to be an S corporation, so I elected to be an S corporation. So now I absolutely have to, in the end of the year, pay salary to myself. And paying salary means I need to run payroll for myself for amount that is similar to any reasonable compensation in the industry. So for example, if I Google how much CPA makes in that specific area where I live, let's say it's 60,000-70,000. So I have to issue myself those 60,000-70,000 as a salary. So now when I issue salary, I paid payroll tax. So payroll tax is together 15.3%, which is 675 as from employee and 675 from employer. So as together, my corporation pays 15.3% of self-employment tax on salary on those 70K. So you would be like, okay, so what is so wonderful about that? The rest of the income difference between 150K, which is the all income, and 70K that I paid myself, that difference will be my distributions, and distributions are tax-free. So that's the beauty of S corporation. So let me tell you more how you set up S corporation and more details about that. So usually S corporation, to be S corporation, you have to make an election. So if, for example, there is a couple of ways to do it. You can be C corporation. So you chose to be C corporation, then you have to file S corporation election with IRS. Or you are LLC, and then I'll be talking about that in a bit, but you can also choose to become S corporation. For my example, as a CPA, S corporation is the best for service businesses or businesses who generates lots of income. So for me as a CPA, I first formed LLC, not so boring LLC, which I will be talking about LLC in a bit, and then I did S-Corp election to be not so boring LLC, S corporation, right? So now every year I issue myself a salary, I pay payroll tax, but the rest of the funds are distributions to myself and they are tax-free. So for example, I'll give you another example. We have a tax return. It's a Form 1120S. I report 150K of net income. Then as expense, I report my salary and my part of payroll taxes. So that will be net income 150K, 70K of salary, and then the payroll taxes. And I'm taking it back. It's both employee and employer. So all of the payroll taxes. So that will be 15.3%. So now my net income something like 60K. So those 60K, I issue myself K1 and I technically don't pay self-employment tax on it. So I save on self-employment. I might have said something in this video that it's tax-free. It's just I'm avoiding paying self-employment income on that tax, and then I pick it up as income on my individual tax return. But C corporation doesn't pay taxes. So the savings are in reality in payroll, in self-employed employment taxes. Let's see what else I have in mission. So S corporation sounds amazing because we saved on self-employment tax, and then S corp doesn't pay tax, so only individual does. But compared to partnership and sole proprietorships, I don't have to pay that 15.3 self-employment tax, which is huge for our industry. The problem is to be S corporation, you have lots of limitations. So some of them is like you cannot issue different kinds of stocks, so it's only one type of stocks. Also, it cannot be more than 100 shareholders. So it's up to 100 shareholders, and there is a limitation on who can be shareholders or not. So for example, foreigners cannot be more than 100, and there is others like partnership cannot be shareholders. Certain trusts can be and some cannot, and also there is a C corporation cannot be shareholders, and there is some estates can and some others not. So there is lots of limitations out there. Let's say, so payroll tax deduction, we can deduct that. There is also a shareholder basis. Shareholder basis is similar to partnerships. Whatever we contributed plus net income, less losses, less distributions. So another things, when we have losses, we can deduct those losses up to the amount of this my basis, right? So for example, I have 10K of basis in S-Corp, in my S-Corp. This year I have 20K losses. I can only deduct 10K losses, and whatever above of that becomes a capital gain. So I can deduct 10K of losses up to my basis, and then the rest of it I have to pick it up as a capital gain. So 10K I'll have to pick up as a capital gain above the basis distributions on my tax return. So it's important for S corporation to make sure we double check the basis every single year for that specific reason. Well, now let's get into pros and cons of S corporation. So pros and cons. Well, S corporation, I think it's wonderful for anybody who is a CPA or service business. It's the best. Or it's like there's a lot of people who this business can be the best. So it can be, I mean, in my understanding, in my beliefs, it's somebody who makes between like 60 to 80K in business, maybe more, maybe 250K. So that kind of stuff. So service businesses, CPA businesses, doctors are often S-Corps. I mean, they might be a little bit higher, but from that's the same idea. So anybody who has like high earnings business and they're not planning to reinvest, there is no really losses associated with it, so S-Corp would be a good entity. So from advantages, we talked about double taxation. That's something we avoid because S-Corp doesn't pay taxes, only shareholders. And then because they have this wonderful payroll, you don't have to pay payroll on that amount between net income and salary, which are distributions. We call it tax-free distributions. That's a big benefit of S-Corp. That is why I have S-Corp. That is why majority of people have S-Corps. So big tax savings via distribution strategy that I just mentioned. limited liability protection. The same as C corporation, S corporation has limited liability protection, so that is wonderful. So another one, it's like I mentioned, it's perfect for profitable active businesses. An example I would give you is CPAs, lawyers, doctors, things like that. With disadvantages, there's more compliance for payroll requirements. So yes, you do need to set up payroll, you do need to issue yourself a salary, other people a salary, and that creates another complexity because payroll is not easy. I don't know if you have done payroll, but I think payroll is one of the most complicated things in our industry, in accounting. So that's a complexity. Another one is must prove a reasonable compensation, like yeah, that's a little bit like, okay, what is reasonable compensation? Even for me, for example, I am a CPA in my business, but I do YouTube, I do courses, I do other things. So is it reasonable for me to issue the same as for somebody working full-time? Probably not, but maybe yes. So it's questionable, but basically the best idea is like look it up, find the best evidence you can find that it's a reasonable compensation, and that should make sense. In case if S-Corp ever get audited, you need to show some proof and explain why. And it's not ideal for passive investment income businesses. Passive investments, yes, because technically you can't keep lots of cash in S-Corp. It's created to create those distributions and things like that. So yeah, and yes, for passive investment for real estate investors and things like that, I'll be talking in the next section, but they usually choose LLC for different reasons. And also, like, you don't want to issue yourself a salary if you're not actively involved in a business. So I would say it's more like for active businesses that generates lots of cash. And again, service businesses, when you do consulting, this kind of stuff, you're a doctor, that's kind of what it is. And let's see what else I missed about S. There is interesting rules about S-Corp liquidations, but that's just something I'll talk more about later. And another one that I think is important to mention, that if it was a C-Corp that converted to be S-Corp, there is some complications related to that. I'm not going to touch in this general video, but just something to remember is that there is some certain extra tax events can be generated if the S-Corp accumulates a certain amount of assets, cash, undistributed income and stuff like that. But that's pretty much all for S-Corps. S-Corps are my favorite. I do lots of S-Corp. I think majority of businesses in the United States, especially service businesses, are S-Corps. Well, let's go, and now let's talk about LLC. And the last entity to talk about is LLC. So what does LLC stands for? It's Limited Liability Company, right? So you can elect to create LLC by filing articles of organization with the state. So what happens? So it means that you created an entity that can be taxed different ways, and I'm gonna explain this. So LLC, when we file articles of organization, by default it is a partnership. It is, if it has two partners, is a partnership, right? It can be elected to be S-Corp or C corporation. So LLC can also be, it can be partnership, it can be C corporation, can be S corporation. So then eventually you have to decide what it is. So when you file it as and it also can be a single member LLC. Let me explain you what it is. So basically it can be any of the entities that I mentioned before. So what does LLC does? LLC it adds additional limited liability protection to the company, and it is a pass-through entity. So it seems like the best of two worlds, but LLC also can be different. So if you just filed articles of organization, if you're one person and you registered with the state, you're a single member LLC. So you're sole proprietor that owns LLC, limited liability protection. If you file it with the state and IRS and it's two partners, it becomes partnership LLC. So partnership plus limited liability. And then you can also file it to be C corporation and S-Corp. So when you see LLC, as a tax professional, you should understand that it can be so many things. So you need to find out what it actually is, right? But LLC is a good idea. So let's get into more details about like why it's great. So basically, as I mentioned, it's a hybrid entity offering liability protection with flexible taxation. Flexible taxation means you can choose by filing certain election. So owners, members, it's individuals or entities that have limited liability, so personal assets are protected, can have different number of members. And yeah, so LLC is pretty wonderful. Let me take a look. What else did I miss here? Yes. So depends on what it is. If it's sole proprietor, partnership, S corporation, C corporation, it also follows the rules for each of the entities I mentioned. So if it's a partnership, it has a basis for partnerships or S-Corp basis, and it can issue multiple stocks. So all these things are possible. So it's really flexible. Yeah, it's really flexible, and it can be different things, depends what you want, but it's a good idea. I do actually personally have LLC. My company called Not So Boring CPA LLC. So the way I created it, I filed articles of organization with the state to choose to have LLC. Why I did it? Because I wanted limited liability protection, and I don't want to deal with C corporation, as that's double taxation, all that kind of stuff. After I had LLC, by default, it would be single member LLC. So it will be a flow through that I pick up under my Schedule C. But that's not what I wanted, because I don't want to pay self-employment tax. So what I did, I then sent out S-Corp election to IRS to be LLC that is taxed as S-Corp. And that's a common thing. So now I'm following the rules of S corporation, but I also have limited liability that LLC gives me. So that could be an example. So let's take a look. Let's go to pros and cons of LLC. So LLC pros. Limited liability protection. So like I mentioned, it has what corporation would give us without double taxation. That is why all over the businesses you see so many LLC tax returns. And that's the reason why people create LLC first and then decide what to do with that LLC. Flexible ownership and allocation rights. So it's a pass-through. So all the income or expenses go to the partners or members, let's call them, they are members. But also you can do flexible allocation, because there is an LLC agreement will be created that will tell how much contributions, how much allocations there are. So it's pretty flexible. So LLC is as flexible as partnership. Tax flexible, it can operate as partnership, S-Corp, C-Corp, or sole proprietor, right? So it might be a little bit confusing, but you should understand LLC is a company, limited liability company. And then if it's one person, it's sole proprietor LLC. If it's two people, it's automatically partnership LLC, and that's it. And then you can automatically, then it doesn't go anywhere else. Then you have to file two elections, or S-Corp or C-Corp, in order for LLC to be one or another. Yeah, so there's a lot of pros, advantages of it. There's no member restriction, unique rights, active participation, limited liability, all that kind of stuff. But there's also some disadvantages. So let's look at disadvantages. Rules and fees depends on a state. Yes, that's true. Not every state is recognizing LLC. So in some states, you can still be that other entities that they recognize. So LLC, not always. And sometimes you have to pay extra fee just because you're LLC. So California has this strange rule. Strange because you have to pay $800 every year if you own LLC as a fee, despite if you make money or not. So I think it's kind of like very unfair, because like when I started my business, I prepared one tax return. That's all. So I made like, not a lot. And then I still had to pay like this California fee, minimum fee for LLCs. So that's not ideal. So check it out, the state you work in or your client is in, to double check. Another one, members active in business pay self-employment tax. Unless you are S-Corp, elected to be S-Corp, then everybody would pay self-employment tax. So if it's just LLC and you didn't make any elections, you didn't choose to be S-Corporation, that will have a problem that sole proprietors have and partnerships have, which is paying that additional self-employment tax on all the flow-through income. It's less appealing for venture funding versus C-Corporation. Yes, usually venture capitalists would prefer C corporations. Why? Because they want that. Technically, LLC has all the things that C Corp does. It can issue different type of stock. It can become a C corporation. But in general, it's just this general idea in the field that everybody wants to deal with, like C corporations. When they do that, they look for Inc. in the end of the company to know it's incorporated. Like, let's say, not so boring CPA Inc., which means I am C corporation, not LLC, which that means I can be anything. I can be S-Corp, I can be partnership, I can be sole proprietor. So it's not obvious for investor if it's C corporation, and that's what they look for. They want to invest. They want to make sure they don't need to deal with filing U.S. tax returns. They don't need to deal with like limited liability and all that kind of stuff. So yes, and what is it ideal for? It's ideal for small, mid-sized businesses, agencies, service providers. LLCs are extremely common. They are common because they can be anything. Like they can be any of those tax strategies, tax entities that I mentioned. So like I mentioned, like I am an LLC, but I'm also S-Corp. And you will prepare the tax return, can be LLC, can be also individual person. It can be like LLC can be also wonderful. LLC actually really wonderful for real estate investors because they can play with it a little bit more. They don't have to do C corporation, which is not ideal for real estate world because you have to do that double taxation. And they don't want to be S-Corps because they'll have to pay salaries to shareholders. That's crazy. That would be crazy if anytime you invest in real estate, you'll receive like wage. And you can't receive salary if you're not actively participating. That would make sense, right? So it's perfect for like passive income. And then you can be a partnership, right? And you would, in addition to it, you would have that limited liability protection. So majority of real estate entities out there I see they are LLCs for that specific reason: limited liability protection and flexibility of allocations. No need to be S-Corp, no need to be C-Corp for that. You can just be LLC partnership or LLC one person, LLC sole proprietor, and then you decide to invest. Example could be, if I am decided to get into real estate business and I just want to get one property and Airbnb that, I would probably form LLC as sole proprietor and just put assets into LLC, which means they protected, they are separate from me, but at the same time, I can still not need to do dividends, I don't need to do wages, I don't need to do any of that. So LLC is pretty wonderful for that reasons. Let's compare different types of businesses side by side. So we started with sole proprietorships. So it's one person, no legal entity. And then majority of businesses, some businesses or majority of them, they started there. And then eventually they change it to LLC or S corporation or even C corporation sometimes, right? So sole proprietorship, it has limited liability protection, non-taxation, they tax on personal tax return, And there's the best for somebody who starts by themselves. I need to start fast. Partnerships. Liability protections. They also don't have liability protections unless they're like LLC, limited liability partnership. But in general, no. Taxation, Form 1065, partnership tax return, Schedule K1, and then that income picked up on a personal tax return. Those are ideal for two founders very early, or just two partners, family businesses we mentioned. Then we talked about S-Corporation. So they do have limited liability protections. They pass through, they have a huge payroll savings because the income between total income and the wages, the distributions are not taxable, not subject to self-employment tax. And it's great for profitable owners, so business that makes lots of profits. Then we talked about C corporations. They also have limited liability protection, corporate tax flat 21%. That is often less than high net worth individuals, and that is perfect for venture capitalists looking for capital. And we also discussed LLC. So LLCs also have limited protection. They have a pass-through by default, but they can be anything. Like we talked about, they can be S-Corp or C-Corp if they decided to. And it's perfect for growing businesses, right? So here's all the structures available out there. So it really depends what business wants, right? So if they want limited liability protection, it's only LLC, S-Corp, and C corporation. But if they don't want to be involved in a C corporation, like disadvantages like double taxation, for example, if not venture capital, then they also only have LLC and C corporation left. And if they're not actively involved in business and not wish to pay salaries, then they have only LLC left, right? So that could be an example. Or if they're just starting out and they don't want to think about all of this, maybe sole proprietorship is the best for them, right? So it really depends what entity it is, what is ideal for, what they're doing, what their intentions are, what's their long-term strategy. So now let's switch to another case. Let's compare at which one should we choose based on scenarios. So first one is VC ventured startup. So we talked about it, right? We already, you know the answer. The answer should be C-Corp. But let's get into more details. Why? Well, first of all, because majority of corporations out there, Amazon, Google, all this, they're incorporated. So by now you should understand and see that pattern. Publicly traded corporations, venture capitals, all Inc. or C corporations. There is a whole taxation rules out there with C corporation when angel investors, and angel investors are investors, there is a name for people who invest in certain companies at certain stages, and they call it angel investors. They have lots of tax benefits associated with that. So for example, it's a small stock investment. If they invest in that certain stocks, the certain amount of the stock they received almost like with much lower tax rates. So it's super beneficial for them. So those people who are in venture capital, they know about those tax rules. So they're looking for C corporation to invest. And something we already mentioned is the foreign investors, NGOs or pension funds. They don't want them to do anything to do with the additional flow through taxation income. So they don't want any unrelated business income. That's actually a terminology, UBTI, unrelated business income taxation. Or foreign person don't want to do anything to do with filing US tax returns, right? So that's why C corporation would be ideal for them, although it comes with a cost, which is double taxation. Next example, solo CPA making 120K. So looking as example of us tax preparers who are watching this tax course, I hope, and as my example, if I'm a CPA, I make active income, right? So I make supposedly I don't have that many expenses, I just have lots of income. That's an idea of those highly profitable service businesses. I hope highly profitable, they should be highly profitable. So I make 120K, and I was like, okay, this is all my income. What am I gonna do with that? I'll pay so much tax in self-employment tax, 15.3% multiplied by 120K, huge amount. And I would be like, okay, so what do I do to self-employment tax? So the only way I can do it is basically going to become S-Corp. So I elected to be S-Corporation. I issue myself a salary, and the difference between the income and wages would be my amount of income that I'm not going to pay self-employment tax on. And that will be huge for me, right? So multiply 80,000 by 15.3% is a big amount, huge savings. So as a CPA or a lawyer or a doctor, I would choose C corporation. So I would do salary and distributions. Another example, real estate investment portfolio. So for those people, what is the most important? Limited liability protection. Where do they get limited liability protection? There is only 3 entities: LLC, S-Corp, C-Corp. C corporation out of the question because it's double taxation, it's too complicated. Those are for venture capitalists. Let them deal with that if they need that venture capital. So we have left LLC and S-Corp. S-Corp, not ideal because I'll have to issue myself a salary, and real estate portfolio is an active income. Why would I issue myself a salary? It doesn't make sense. So the only thing I'm left with is LLC, right? LLC that would give me limited liability protection. So that's how we make decisions based on those kind of things. No entity is ideal. The choice for entity depends on so many things, and like you already know, those are taxes, limited liability protection, strategy for future growth, and like ownership goal, future scaling plan. So it really depends what you or your client wants to do. Well, depends what kind of entity is the best for them. So I hope that was helpful, and after this video you would be able to figure it out yourself, what is the best entity for you, for your client, advise them, and eventually when you get into tax saving strategies, there is a lot come from this entity structure. So there's just so many exciting things out there. I hope you enjoyed this lesson. I'll see you in the next.